All right, well, after months of talk of a new normal for economic growth, recent data and some political headlines have economists revising their forecast for 2011. Stocks rose last week after President Obama announced a 2-year extension of the Bush-era tax cuts, and U.S. consumer confidence jumped to a 6-month high. That's definitely been playing out in the market. Let's talk now, though, with a couple of leading economists who are reevaluating their predictions for next year. Michael Feroli is a chief U.S. economist for JPMorgan Chase, and based on data compiled by Bloomberg, he's a Bloomberg best forecaster of the economy. Also with us, Chris Varvares. He's president and co-founder of Macroeconomic Advisers. Chris, Michael, good to have you here on Street Smart. So, Michael, let's kick it off with you. No new normal in your view, or how are you revising kind of your outlook for next year?
Right. So we revised up based on what we learned last week in the tax package. We, like most forecasters, had expected the Bush tax cuts to get extended, but I think what was new was the reduction in withholding taxes, and in our minds that adds probably about 0.5% to growth next year. Just in terms of the amount of income it puts in the hands of consumers, we think will boost consumer spending early next year.
So what does this say, Michael, about the new normal? I mean, we hear PIMCO saying this is still a new normal, but we think because of this incredible stimulus, we're going to revise up our forecast for 2011 for them in the fourth quarter. But you're basically saying the same thing.
Yeah, I mean, look, I believe over the next 10 years, there are a lot of challenges for trend growth in the U.S. That doesn't mean you can't have cyclical periods of stronger growth around that trend. And we think, next year you are going to get above trend growth. So even if there are long-run issues weighing on potential, it doesn't mean you still don't have a business cycle around that that trend.
I mean, Chris, you guys have been above consensus for 2011 for some time.
That's right. So we've been looking for growth around 3.5 or a little stronger for a while. And it's mostly because we've rejected the new normal argument. If the new normal meant that the consumer sector had fallen off the track, we don't buy that. What we think is the consumer sector was following the track. The track was weak because of the hit to wealth that occurred during the recession and the financial crisis. But as wealth gradually recovers and consumers follow that track upward over the next couple of years, you could still have strong consumer growth. And that strong growth could still be consistent with the notion that there's deleveraging. A somewhat elevated saving rate, but not rising, still allows consumers to pay down debt and gives you growth of consumer spending that can be in the high 2s, low 3s, and that's consistent with growth in the overall economy well above 3%.
Although the idea of deleveraging, Chris, is kind of a new one for U.S. consumers. Is it one that they continue to stick with, do you think, and how far do they still need to go?
Well, as I said, a rise in the saving rate from 2% to 5 to 6% implies hundreds of billions of dollars of additional saving that wasn't there before. And remember, to the extent that some of this is done on the part of consumers to replace wealth that was lost as a result of stock price declines and house price declines, that can be made up over the next couple of years as house prices very slowly recover, but as equities do much better over the next couple of years.
I want to play devil's advocate a little bit because we're going to be talking with Joe Quinlan in a little bit. He's got a book out, The Last Economic Superpower, and he talks about the end of American dominance. I mean, Michael, aren't things changing? I mean, isn't kind of the era of some of the developed nations, most notably the United States and some others in Europe, I mean, their time is over, and now it's going to be the developing economies that really dominate economically and globally going forward. So maybe we do have a new normal going forward.
Well, I don't think it's a zero-sum game. I don't think there's any reason the developed world has to grow slower just because the emerging world is growing faster. I mean, I think I agree with a lot of the points that Chris made. We do think that consumers can grow at a decent pace here, even though they're deleveraging. And so, it's going to be a challenging period, but I don't think, we want to get too swept away with the pessimism. I do think we're going to have above trend growth for the next couple of years.
What is trend growth right now? I mean, PIMCO's Bill Gross told our Tom Keene the other day it used to be 5-6%. Now we're looking at 3% with 2% GDP growth plus 1% inflation. What are the numbers you guys are playing with? Michael, why don't you start?
I mean, on the real side, I think we're looking at more like 2.25 to 2.5 on real trend growth, and I would say about 1%, maybe a little more for trend inflation for the overall economy.
Chris?
Yeah, we'd be probably a little bit higher, 2.5 to 2 3/4 perhaps on real growth. And I think you have to take the Fed at its word that it would like to see inflation get closer to 2% once we recover enough cyclically.
What about the unemployed? I mean, don't you need to see 3% or even more to start working off some of these unemployment levels?
Right, and that's what we're looking for over the next few years.
All right, so guys, net, I mean, what's changed? If there is no new normal, did anything change? I mean, if you look at the worst financial crisis, the worst economic crisis since the Great Depression, I mean, Michael, you're telling me nothing's really different going forward?
Well, no, things are always different, right? I mean, in the 70s, you had a period of very slow trend growth. In the 90s, you had a period of very strong trend growth. And these things just change. They're always changing. So is there a new normal? Yeah, but I mean, I think there's always a new normal in some way.
Hey, saving about 40 seconds for you, Chris. I mean, weigh in on that. I mean, what's changed in your view going forward?
I think what is different is the nature of the financial headwinds, the fact that the financial system suffered a massive blow to its infrastructure. You know, the shadow banking system basically collapsed, securitization collapsed, and credit is really the problem here in this recovery. It's not the behavior of the consumer sector. It's really what's happened in the financial sector itself.
All right, we're going to leave it on that note. Chris Varvares at Macroeconomic Advisers, Michael Feroli over at JPMorgan Chase. Guys, thank you so much. We appreciate it.